Finance. Warren, a very good evening to you. I'm afraid I've squeezed us for time a bit trying to talk about share buybacks and finding out what FNB are doing in cell phones. And one SMS that says if I want to go to a bank, I go to a bank. If I want a car, I go to a car dealer. If I want a cell phone, I'll go to a cell phone dealer. But that's another story. So we've got 5 common investing myths to very quickly debunk here in our personal finance slot. And let's begin with number 1, which is it's too late to start.
Yeah, I think it's probably the one excuse that a lot of people give themselves. I've waited too long to save, and it's pointless starting now. And to me, that's really a soft excuse. It's never too late to start. I mean, if you're 50 and you think you've only got 10 years to go to retirement, and it's just too late, you forget that you've got probably another 30 or 40 years of life thereafter. So the time to start always is now, and always get the compounding effect working in your favor. I mean, it is the 8th wonder of the world, and you've got to make it work for you.
Okay, it's never too late to start. Myth 2, you can time the market.
Yeah, I mean, I love this one, and you often hear fund managers, talking this one through about, being able to choose the right asset classes and even the right shares at the right time. And I think what people forget is, a market timing is not just one decision about getting out of the stock market before it crashes. You actually have to make 3 decisions. You've got to buy in low, sell out high before the crash, and then thirdly and most importantly, buy in again at a low price. And very often, that third decision is where everybody falls down. It's just not possible to do. To me, it is a myth.
Okay, myth number 3 is it worked for them, it'll work for me.
Yeah, so sitting at the dinner table or at the bride, listening to your mates talk about, how they've bought, 20 residential properties and are renting them all out, and how easy life is, as an investor. It might work for your mates, it might not work for you. And buying and renovating houses, or choosing individual shares on the stock market, and how easy it is. I think we have to realize that people only talk about their successes when they talk about money. They rarely talk about their failures. So don't be suckered into listening to other people's successes and how easy it is. It's definitely not.
Or interrogate them a bit, as you say, and find out what maybe didn't work. Myth number 4, past winners don't mean future success.
Yeah, I think we see this quite a bit in the unit trust space. When you see the top performing unit trust that wins one or other award as the best performer of the year, it's absolutely no coincidence that in a month or 4 thereafter, you see money absolutely piling into that fund. And the sad part about that is that top performing fund very rarely is the top performing fund the year after. Very often, in fact, it's at the bottom of the rankings. And I think we're seeing it again this year where the funds that are doing particularly badly in a year, you see money flowing out of those funds, and it's no surprise very often to find that fund performing extremely well the year thereafter. So if you're going to do anything, actually, what you should do is buy the one that's seeing the biggest outflows, because most likely that will be the winner next year.
Okay, myth number 5, that risk equals speculation.
So that's an interesting one, especially right now. If we look at our stock market, people looking at the stock market falling, and suddenly, they equate the stock market fall to just, that's the very definition of risk. That volatility of the stock market. And to me, I think you have to look at risk very differently. The stock market's a volatile place, and I don't think we should confuse volatility with risk. I think putting all your money in cash and getting certainty that you can get 6 or 7% interest is incredibly risky, because you've absolutely guaranteed that your money will never beat inflation. And I think that, to me, when you're investing, that's always the thing you need to be focused on, is how can I beat inflation? And that means you need volatility. It means you need to be in things like shares and listed property.
Warren, thank you very much. Good, punchy, concise, common investing myth debunked, 5 of them in our regular personal finance segment.